afternoon, invited guests, speakers, participants. I acknowledge the presence of Dean of School of Arts and Science, Professor C Rangarajan. Thank you for coming. So we are going to have a very interesting industry panel on emerging trends in monetary policy. The panel consists of stalwarts of monetary policy in India. We have Dr. C Rangarajan, Professor Ashima Goyal, Dr. Tirthankar Patnaik, and chairing this session we have Professor Jayanth Varma. May I request you all to please come on the stage. Let me take this privilege to introduce Dr. C Rangarajan again. So Dr. C Rangarajan is a former Governor of Reserve Bank of India and a distinguished university professor at Ahmedabad University. Professor Rangarajan obtained his PhD from University of Pennsylvania in the United States. He taught at Wharton School of Finance and Commerce, University of Pennsylvania, and the Graduate School of Business Administration, New York University. In India, he taught at Loyola College, Madras, University of Rajasthan, the Indian Statistical Institute, New Delhi, IIM Ahmedabad. He is the author of several books on Indian economy. His recently published book is Fox in the Road, My Days at RBI and Beyond. And I would request students to read that book. It's such an interesting book. We have Professor Ashima Goyal. She is Emeritus Professor, IGIDR, Mumbai. Currently, she is a member of India's Monetary Policy Committee. She has published more than 100 articles in national and international journals. She has also authored and edited a number of books, including Macroeconomics and Market in Developing and Emerging Economies. She was a visiting fellow at Economic Growth Center, Yale University, USA, and a Fulbright Senior Research Fellow at Claremont Graduate University, USA. Her area of interest are open economy, macroeconomics, international finance, monetary and fiscal policy, financial markets and regulation, institutions and development. We welcome you, ma'am. Thank you. We have Dr. Tirthankar Patnaik, who is also one of the panelists here. He is Chief Economist at National Stock Exchange at India Limited. He has more than 20 years of experience across India's macro and portfolio strategy, quantitative finance, and consumer banking analytics. Dr. Patnaik started his career as a researcher at IGIDR and worked on a number of academic and corporate projects in the area of econometrics and quantitative finance, followed by stint in consumer banking analytics as an analyst with the global consumer group of Citibank in India and Europe. Prior to joining NSE, he was the chief strategist and head of research for India at Japan-based Mizuho Bank. Dr. Tirthankar has PhD from, again, IGIDR Mumbai, where his area of research was high-frequency finance and market microstructure. He also has MSc in statistics and BSc in mathematics, both from University of Madras. We welcome you, sir. NSE is also one of the sponsors of this event, and they are also like to sponsor the Best Paper Award. The session will be chaired by Professor Jayanth Varma. He is currently a professor of finance and accounting at IIM Ahmedabad. He did his doctorate and postdoctorate in management from IIM Ahmedabad, where he was awarded gold medal for scholastic performance. He is also a qualified cost accountant. He teaches courses in capital market, fixed income, alternative investment, risk management, and corporate finance. Professor Varma is currently a member of Monetary Policy Committee, so we have two members of Monetary Policy Committee talking on the same stage. So it's a delight to watch like both monetary policy committee members talking about and discussing about monetary policy. So Professor Jayanth Varma has been a full-time member of Securities and Exchange Board, popularly known as SEBI, for a year. He has been a chairman of Secondary Market Advisory Committee and several other committees of SEBI. He has also been chairman of several committees set up by Former Markets Commission and Ministry of Finance and Company Affairs. Professor Varma was a member of Raghuram Rajan Committee on Financial Sector Reforms of the Financial Sector Legislative Reforms Commission. Professor Varma has been on the board of several companies, including Axis Bank Limited, Bharat Petroleum Corporation Limited, Gujarat International Finance Tech City Company Limited, Infosys BPM Limited, and Punjab National Bank. Professor Varma has carried out extensive research in the field of Indian financial market and finance theory and published extensively in Indian and international journals. He has authored extremely popular books on portfolio management and on the Indian security scam. His book on security scam was national bestseller. Professor Varma has more than 100 papers and cases to his credit. In addition, he has published more than 100 articles in newspapers and other periodicals. We welcome you, sir. He's chairing the session. The forum is all yours.
Yeah, it's a great pleasure and privilege to be here along such a distinguished panel. And Dr. Rangarajan was my professor at Ahmedabad. I was just telling him I was in the last batch that he taught before moving to RBI. It's it's a great pleasure to be on panel with such distinguished people. Now, as I looked at the panel, the thoughts that came to me was that the panel is stacked with insiders. Two people who are on the existing monetary policy committee, and one person who's as governor has done monetary policy. So I was a little concerned that you will get too much of an establishment view about monetary policy. The only foil that we have for the insiders is Tirthankar, who fortunately is far away from RBI. He's not even in a bank where he can be intimidated by RBI. So, and he sits very close to the markets. The markets, as we all know, don't care about anything, So they are, they are not easily intimidated, and he knows what the market thinks about each monetary policy. So I hope there will be a bit of a foil to that extreme establishment bias in the panel. Also, given that strong establishment bias, I thought I would begin by posing a kind of contrarian perspective on this. It's also something that has worried me about monetary policy during the last 20 years or so, which is that if you look at the global financial crisis, it appears to tell us that monetary policy guys, inflation targeting and all of that, they have got inflation under good control. But in the process of getting inflation under control, they took the eye off financial stability. And they goofed up very badly on financial stability. And the response to the global financial crisis was that a lot more focus on financial stability. So that when COVID came along, central bankers around the world focused a lot more on the financial system. And perhaps in the process they took the eye off on inflation, which is what we have ended up with in the last couple of years and so on. So it appears to me that 21st century has not been very kind to monetary policymakers. In fact, it makes me wonder whether monetary policy is fit for purpose. If you want to get both financial stability and growth and inflation, have monetary policymakers around the world in the 21st century being able to deliver that? Or has the 21st century perhaps reinforced the Milton Friedman kind of view that using monetary policy to fine-tune the economy is so difficult, almost impossible, that we should not even try to do it. So where do we really stand on monetary policy, looking back at the 21st century? Again, one antidote to having too much of Indian monetary policy people here would be to spend some time on global monetary policy, where we can also speak a little bit like outsiders. So, can I begin with you, Dr. Rangarajan?
Yeah, well, I was told that each member will speak for 5 or 6 minutes or something like that.
Sure.
And I will come back to the issues that you raised a little later.
Sure.
But let me put 2 or 3 main concerns about monetary policy, which is even within the fold that you talked about in terms of controlling inflation and so on. First of all, I think much of the discussion on inflation very often centers around the price of petroleum has gone up, the price of food has gone up, and therefore inflation is rising. I think this is a very wrong approach, because in my opinion, which I have written about earlier also, that given a certain level of nominal income, whether it is at the household level or at the national level, the rise in the price of any one commodity cannot result in the increase in the general price level. In fact, less will be available for other commodities, and therefore the prices will come. It is essentially the accommodation that we make as a consequence of the increase in the prices of certain commodities. Then the whole question of the price level, general price level going up. And therefore I will want to quote from Milton Friedman, the statement: "It is true that the upward push in wages produced inflation, not because it was necessarily inflationary, but because it happened to be the mechanism which forced an increase in the stock of money." Therefore, in order to adjust to that, we take action, and money or liquidity, whichever way term that you want to use, increases, and that is what leads to the increase in the price, general price level. Therefore, in some sense, the cost push inflation by itself is a myth. Cost push inflation triggers, but it is sustained only because of a macro variable like liquidity or even interest rate is adjusted. So then I think the whole question is, we need a theory of inflation. We are really operating very often without an appropriate theory of inflation. And the theory of inflation, when we talk about, we all go back to the old quantity theory of money. That is the MV is equal to PT, and therefore a change in M, other things remain constant, each year increase in price level. The biggest problem with this formulation was essentially that money does not have any effect on T transaction, which is, let us say, is the income. That is a neutrality which is not valid, in the sense that as money increases, it has an effect, because of the process of money creation is also the process of credit creation. Money doesn't come into existence unless credit to the government or credit to the private sector goes up. Therefore, in some sense, the real problem is when there is an increase in liquidity or the fall in the interest rate, then what happens to output and what happens to demand is a critical question. That the demand effect has to be separated from the price effect, the output effect. With the combination of the two, it will finally give you the increase in the price level. One study I had done many years ago, almost at the time when you were when I was in the IIM and you were there, that the demand effect is stronger than the output effect. And the paper of that vintage, which talks about that. So I think in some sense, it also turns around to the other question, namely, which is critical, interest rate or quantity? I mean, this is an old debate. Now, even if you look at interest rate, the question really bothers once again to centers around whether it is a short-term interest or the long-term rate of interest. Keynes talked about long-term interest, and you also know Hartley talked about the short-term rate of interest. One talks about the investment behavior, and the other talks about the inventories, and therefore there is really no consensus on whether it is a long-term interest or the short-term interest which is relevant. Unless you argue the market is so perfect, you act on the short-term market and then it will apply, it will also go to the long-term market. And therefore the Bills-only doctrine that the Fed adopted at one time essentially meant you have a fluid market in which from the short-term end you can go to the long-term yet. But I think that the two are interrelated. The point is that in the multi-policy statements, that you have this first, the decision that is announced about the policy rate will be up or down or stay where it is. And then there is a statement about the liquidity, that it is accommodative, not accommodative, withdraw and all that. Now this, in my opinion, is redundant. You cannot really talk about raising or lowering or keeping the rate of interest without acting upon liquidity. The first instruction, as you know in the Federal Open Markets Committee, is indulge in act through open market operations to come to a particular level. Therefore, in my opinion, the central banks cannot order interest rate. You cannot say the interest rate can be raised or lowered. You have to act in order to make the rate of interest stick where it is. And therefore, you have to act on liquidity in order to be able to do that. Therefore, the question that arises is that Robertson wrote, and recently Stigler has also wrote these in his book, that it is money that comes in. And then as a result, that is also created because of the credit transactions. And it is the credit market which becomes relevant. Therefore, my point is that the Reserve Bank of India should, in fact, I'm not part of the establishment now. The Reserve Bank of India must, in fact, pay more attention also to the quantity of money and what happens, or define your liquidity in a better way than what it is being done now. What is happening at the discount window on the liquidity adjustment facility is not a total description of the liquidity in the system. I think the liquidity in the system is much wider. And if you look at the reserve money, you see behavior of reserve money. It was in double digit in the early period, then it has almost come down to the single digit now as far as the reserve money is concerned. I think that is critically important, and I think we should note it. And since I've given only 5 minutes, I will make one more point and then come back to your thing later on in the course of the discussion. I must also say the latest governor's statement also gives the balance sheet of the Reserve Bank of India coming down. Well, the Fed statement clearly states a target level. Actually, the assets of the central bank will come down from X to a lower figure. There will be a contraction of the balance sheet. The governor's statement here only gives the number as a percentage of GDP. It does not very clearly indicate whether the balance sheet itself is shrunk or not. It may not have shrunk because the GDP has increased and the percentage fall may not have offset that. So anyway, that's a point. And finally, I think you mentioned about how we handle COVID. Now, how we handle, we meaning not only India, US, UK, everybody, handled it. Is exactly what the textbooks used to talk about, helicopter money, or you get up one day and find under your pillow money. And then what happens to the system? That's exactly what happened. That pushed money into the system. And the worst thing happened in the United States, where a check was issued to every household in the country. And then, I will just give only one number. The fiscal deficit of the United States in 2019 was something like 2.2% or something. And it went up to 18% of the GDP in the next year. Same thing happened in UK. The numbers are exactly similar to that. Our numbers also increased, but not as drastically because we also operated with some constraint on that. But what I say is essentially, this is a proof of the quantity theory of money. That if you really wake up, and have money in your hand, what will happen ultimately is the general increase in the price level. Now, you talked about conflict of objectives. People usually talk about the conflict between price stability and growth. Well, there are other concerns which are also coming in, like financial stability or even exchange rate stability, because some people talk about that also. In a large sense, the primary conflict is really between growth and price stability. Financial stability, under certain circumstances, can be taken care of if you take care of that dilemma itself. But the point is that therefore, in that sense, the inflation targeting, in my opinion, is a good compromise in terms of the situation. But all the problems will arise, how you interpret inflation target, and how long can you stay outside the comfort zone, how quickly you should come down. The Fed said very categorically, I want to go down to 2%. We are saying, yes, we should go 4% is good, but when will we go? We have not indicated whether we should go to 4 or whether we should stay between 4 and 6. And all of that question arises. But still, I think it is a good compromise in terms of the two objectives. And there are issues associated with it. I will stop here. And if the occasion arises, we will talk about it.
Ashima?
Yeah, thank you. So I think I second Dr. Rangarajan in asserting my independence. I'm an external member of the MPC, so are you. So we are not insiders here by any, yeah. I think I would like to say that this experience of flexible inflation targeting in the last few years, it has shown us that it really works in the Indian context, because with the first MPC, when inflation targeting was adopted, inflation fell steeply below 4, but that was when oil prices fell. And a lot of people had the view that how is this going to work when oil prices rise? It might not work. And we have actually gone through a test of fire, because not only did oil prices rise, the Ukraine crisis, we also had the pandemic, supply chain bottlenecks, we had tomatoes going by 600%. And food price shocks, all sorts of supply side shocks. But inflation, I showed this chart in the morning. The volatility of inflation has really come down in this period compared to the past. The wholesale price inflation was very high, but our target headline remained within bounds largely. So, and I just calculated that this MPC from November to November, the average inflation headline was 5.8%. So we are overall below, within the tolerance band. And Dr. Rangarajan's point about 4%, about at least 3 times I know our forward forecasts were approaching 4. But then there was something happened, Ukraine crisis in 22 and so on. So again, we have these forecasts and currently, because originally with the pandemic when growth was very badly affected, the emphasis was more on recovery. But as growth recovery is robust, the emphasis has turned to inflation. And we are all talking about the inflation target because markets had internalized that this MPC is comfortable with 6% and so on. We know it is 4% and we are keeping real rates at a level that will bring us towards this 4%. So here Dr. Rangarajan's point about interest rate or quantity, I think in India both matter. I've done some research on this also. So the details of liquidity and durable and short term, and it's true that the way the MOU has been constructed, the MPC does not have anything to say on liquidity. It has not been given that power. But I think if it was, then there would be much more transparency about different components of liquidity. Although I do try to raise this issue in my minutes and discuss it. But that is, we need much more transparency and details, because durable liquidity has to remain somewhat tight when you are in a disinflationary mode. But under inflation targeting, short-term liquidity adjusts. But it is the interest rate which matters, and with the benchmark prime lending rate, the pass-through is much faster on the bank side to loan rates. And also I think in India, because we have a young population, earning salaries, buying new houses, equipping it, the interest elasticity of demand is also quite high. So what the real rates are does affect demand and therefore inflation and growth. So the second point I would like to emphasize is that although inflation targeting has worked, what has really worked is flexible inflation targeting. And here I think our Indian practice during these pandemics, or all of macroeconomic policy, does show how flexibility and adjusting to the requirements, to the domestic requirement, to the domestic theoretical and structural issues, really helps improve outcomes. Because the issue Jayanth raised about financial stability. We have seen with the kind of, I think Dr. Rangarajan was instrumental in setting in this sequenced capital account convertibility. So liberalize first for equity, keep debt caps, build up reserves, all those, and then currently macro and micro-prudential. Dr. Reddy was India was the first to apply these. So all that helps, people expected, because our financial sector was under stress all through the 2010s, they expected things to blow up with the pandemic. But it actually improved, NPAs fell, balance sheet strengthened. So this is all about the kind of reform, strengthening of financial regulation. So flexible inflation targeting means, I like to say that we are concerned with inflation as a primary communication tool, because that helps anchor inflation expectations. But we are going into everything that determines inflation. And this includes financial stability, it includes all sorts of other variables that we look at and that we are keeping an eye on in the NPC and the Reserve Bank, of course, and other macroeconomic policy makers. So flexibility is very, very important. The third set of points, I have this acronym, to summarize, I think, the main lessons we've learned over these last 3-4 years, which is B with 4 C's and then R. So B stands for balance. Balance between, I think India did well because unlike the US, we did not give too much of a demand stimulus because we realized there's supply side bottlenecks. That I know was in the EACPM, and this policy was consciously drafted that we can't afford to give write checks to everybody when we have 1 billion plus population, and we had the DBT, and so you could make some targeted transfers. And so balance between all sorts of the issues I've talked about and the flexibility come here. And then the ability for policy to be counter-cyclical. I think the 2010s and earlier, because India, we were developing the LAF, the money market, we did not have the ability, and we were open. Unfortunately, when India opened, that was the period of the East Asian crisis, the global financial crisis. We had endless and a susceptibility to oil price shocks. This period so I showed this chart in the morning, the huge fluctuations in oil prices that have happened, especially after 2000. So we are at the receiving end of all this. And the focus was more on structural reform, putting in place an inflation targeting regime in the 2010s, rather than smoothing these shocks. But today we are in a position where there's enough diversity, depth, we have enough buffers. For example, after Ukraine, when the RBI was really using reserves to smooth as outflows, as large equity outflows, markets are very worried, reserves are going down, they think you can go on adding reserves and you start using them. So I think one of the things we've been trying to communicate through the MPC is that we have degrees of independence from what the US Fed does. We have ways to implement counter-cyclical policy, and we don't have to follow, the interest differential, the UIP, that because of our sequence capital account convertibility, we don't have to follow the US Fed. We have caps on debt flows and so on. I talked about this again in the morning. So we are counter-cyclical. Then the other C stands for coordination between monetary and fiscal policy. Now, very often people think that under inflation targeting or in general, and again, Dr. Rangarajan was instrumental in stopping that automatic monetization of the fiscal deficit. There was total fiscal dominance earlier. But today, you can afford coordination along with autonomy, independence, and credibility because you are in an inflation targeting regime where you have to raise interest rates if inflation is high. But at the same time, a lot of the cost push factors come from the supply side, and the government can do much more about reducing, say, oil taxes or about intervening in the food economy or the long-term improvements in infrastructure, the kind of cross-subsidizing electricity, which makes India a high-cost economy, these kind of reforms. And the conscious choice was that we will continue with reform and these kind of issues. And this was decreasing GST, for example. It reduces the octroi and the waste in fuel and the sort of costs that all industries had to bear earlier. So we see those kind of costs coming down. Then the interest rate can be kept somewhat lower. Inflation is within the tolerance band. We can be more comfortable. We don't have to raise rates. We can keep. So because what monetary policy does affects demand more. And at the same time, you need a conservative fisc. So that is the other aspect of coordination. Again, the government has shown restraint under severe shocks without too much of a rise in deficit and a quick resumption of consolidation. So then the third C is really credibility. And here I've just said why it is credible even though you have some coordination. And that in the E in credible captures expectations. That credibility is very important to anchor inflation expectations. We keep talking about the target. Compared to the 80s and 90s, we used to have double-digit inflation in India. Now people are worried if it exceeds 6%. So there is this realization that inflation is going to be lower, it's going to be in single digits, hopefully it will come to 4. Then the fourth and final C is about communication. So that is also an important part of inflation targeting. Markets really want to hear from you how long you're going to keep rates fixed but that is not the key aspect of communication. And you can't do that when there's a lot of uncertainty because you have to be data-based. So you tell markets, you tell them what your reaction function is, what your objectives are, communicate your target, they should internalize that. They know that if inflation is higher than the target, we will be keeping rates higher, keeping real rates positive. So they know the reaction function. They can infer from the data coming in what the NPC is likely to do. That is the way communication works. But we have seen, like the Fed, for example, is higher for longer. I just discussed this morning, that if you make unconditional statements of you're going to do this for so long, you will have to change and you'll have egg on your face, especially in uncertain times. Then the final is R is reform, which is also related to improvements in regulation, to supply side factors that reduce costs. So these were the 3 broad points I wanted to make. I'll stop there.
Sir, so first of all, you are lucky to have a teacher on the dais. I'm also lucky to have a teacher on the dais. Dr. Goyal was my teacher at IGIDR. Sir, my take would be, since you said I'm from the markets, let me look at it from the markets perspective. 2022 was a year in which central banks raised rates significantly. Somehow, despite all the conversation about central bank understanding, the worries that you had initially mentioned came through, that even in developed markets, in the interest of financial stability, the eye on inflation was taken off. They lost the plot there, and we had 9% inflation in the US. From a global markets perspective, the last time we had seen such high inflation was during Volcker years. It took policy rate, Fed fund policy rates to go to 19% to arrest inflation, and it was 40 years before inflation actually came back to in such ferocity. But institutional amnesia is not a problem. It's a global problem. I think that's what was understood. So central banks all the way until February 22 were in their commentary, especially the Fed, had a transitory adjective in their inflation commentary, saying inflation was transitory. It took the Ukraine war for the transitory component to go away, for the transitory, the word to go away, and Fed went hammer and tongs behind inflation. So several rate hikes. RBI also did. So we went from 4% on the policy to 650, thanks to the FEC. And inflation, over time, it came back to, in the US, fell back to 3% or so. It came close to 3%. But, so I want to speak about 2 points here, sir. One is, did we follow the US in the same way? And secondly, what happened to markets? I just wanted to spend some time there as well. So first of all, emerging markets, we down from the fragile 5 period of 2013 or so. If the wind blows hard in developed markets, emerging markets do catch a cold. That was the idea. So one point that came out was emerging market monetary policy need not always go exactly in sync. It may be in the same direction, but it need not be proportional. That was definitely the case. And the conversation in India, from market's perspective, was somehow, despite the helicopter money that was thrown about in the developed markets, the response function here was far more conservative, prudent, and fiscally conservative. So it was also meant to address places in the market, places in the demand system where it really mattered. So rather than provide rather than provide money, for instance, credit was made available at several levels. So we had the emergency credit line guarantee scheme. We had the Pradhan Mantri Garib Kalyan Yojana, which looked at providing food to about 800 million people. That has now been extended to by another 5 years or so. At that time, it may not have seemed much, but it seems to have brought India out in a way where our fiscal deficit numbers are sort of in line, now coming down further. We have pushed FRBM for a while. The argument there has also gone towards the debt GDP numbers rather than a fiscal deficit number. But we seem to have come out unscathed. Now let me look at how the market really looked at it. Now 2022 was a year in which FIIs sold because there was such an outflow of capital from all emerging markets. When the Fed raises rates, you have an outflow that was expected. S&P 500 went down 19%. In the markets, we say 20% is bear market territory. Nasdaq went below 20%. Other risky assets, similar risky assets, say MSCI emerging markets, went down 30%. So 2022 was a year in which there was a global flight of capital. The outflow from Indian shores was the highest ever since we have data from the early 90s. What happened to the markets? Indian markets went up 5.7%. The big change was household allocation to equities. Household allocation to equities, both directly and indirectly. So that made sure that the amount of capital that went out through foreign outflows was more than made up by inflows from domestic institutional investors and direct retail investing. So this may not have come about if many other factors had also not come in place, of which one of them was an increasing sense that inflation is not going out of control. There were other factors. There were other factors like people looked for higher returns on their assets and wanted to move away from fixed income assets. People also had enablers like better technology, cheaper phones, identification systems which allowed people to get into the markets quickly. So we had 27 million people who traded in the markets in 19. Today we have 85 million people. So that number seems to be going up seems to be going up. But one of them was also that inflation has not gone out. We do see household expectations from RBI surveys where we saw double-digit numbers, 11% or so. But overall, the direction has been sort of downwards, and the recent, how India has come out in 2023, in the fourth quarter of the year, where foreign investors have come back and in a hurry. So markets in November went up 5%, markets in December went up another 7%. India has ended the year 20% up. Bull market, proper bull market. The market cap has gone up about 29%, sir. And what is interesting here is foreign capital seems to be coming in towards the riskier aspects of the market, not just large caps, but now into mid caps and small caps as well. There is renewed foreign investor interest. And one part of it is that the Indian market stands out from its growth perspective, the highest growth in the world, and also from a stability perspective. There are very little worries that when we talk to foreign investors, we hear that is inflation going to be out of control? Is given the sharp rise in crude, given fragmented geopolitics, we don't have a single hegemon anymore. We are in a multipolar world. Tensions with China during Gulf War in 2020, then the Ukraine war, then this Israel-Hamas. There's so many things, but markets have continued to sort of repose faith in Indian markets. And one part of it is also that inflation is reasonably under control. And that is something the market expects to see going forward as well. From an indicator perspective, core is well within target. Markets also saw that initial MPC commentary was keeping in the 4 plus or minus 6%, plus or minus 2% band. And as the inflation trajectory came within that band, the focus shifted towards target. That part is also sort of visible, and somehow we don't see concerns on that front, sir, from a market's perspective.
Thank you. Since the title is Emerging Trends, I would like to pose one question to all of you about what is happening to household balance sheets and the household sector becoming short duration in a bigger and bigger way, and primarily coming from housing credit. India is one of the countries where housing credit is almost entirely floating rate. So you have 20-year home loans which are floating rate, and which makes the household sector hugely short duration. And also the thing points that Tirthankar mentioned, that on the saving side, savings shifting towards equities and other things, which is the savings are no longer as long duration as they used to be. So if all your savings were in long-term deposits, there is a hedge there that your savings is long duration. But if that shifts to equities, the household sector becomes short duration, and housing credit is expanding. So if we look forward 10 years from now, do you feel that this could become a constraint on monetary policy? That the big duration risk is not sitting on a bank balance sheet or an insurance company balance sheet, but is sitting on household balance sheets. And also the fact that household balance sheets have less access to derivative markets and so on, where the derivative risk can be managed. Or would we need a retail-friendly interest rate swap market, where the household duration risk can be managed to make monetary policy less constrained in this sphere? Because much of the developed world, not only housing loans are fixed rate. So the housing sector is not short duration in the way Indian markets are and some emerging markets are. So could we get to the point where raising interest rates by 1% becomes a political bombshell, because EMIs go up for such a large section. Even in 23, that was obvious that the rising EMIs became a point of concern. But that was on a much smaller stock of household credit. We look forward 10 years from now where the household credit has tripled, quadrupled, and it remains floating rates. Could this become a constraint on monetary policy? Yeah, can I begin with you?
Well, I think when you look at what's going to happen 2 decades from now, there are many other issues that are more dominant than the question that you raised. But this is certainly one issue. In fact, one concern now about the way household behavior is the latest data which shows the household savings have come down. I think this is much more critical than whether it is a flash in the pan, I mean, it's just a 1 year phenomenon, or is it going to be a permanent phenomenon? Is a critical question, because I think that is, and people are examining. I also wrote an article on it, but people are examining it in terms of financial assets, financial liabilities. That's not the way to analyze it, because financial assets, liabilities, and all that come later. You know what you want to save, and then you decide where you want to put it. I mean, it is not the other way around. Just because we do not have a way of directly estimating household savings, we go through this route of financial assets, real assets, and then add them up and say, this is the savings of the household. But the point really is, one of the most critical issues that we will have is whether the household savings are going down on a permanent basis. That would be a real concern in terms of growth, in terms of how we really shape it. But coming back to the one question that you were asking about the impact of monetary policy, the whole question centers around the one big issue. What is the impact of interest rate on decisions by households, corporates, and others? There has been a lot of literature on the subject, and I can tell you, after reading all of that literature, you come to a very agnostic conclusion. There are studies which say the rate of interest does influence corporate behavior. There are studies which say that what the Radcliffe Committee said, the 3 gears view. That is, if you move from one gear to another gear, then it will have an effect. But if the rate of interest is only within a short magnitude, then it does not have an effect. So if you go from 4 to 7, yes, there will be an effect. But if you go from 4 to 4.5, as we normally do, 0.5% is the biggest thing that we want to do at any one particular point in time, then it does not have. So I think, but the fact is, all studies show that the rate of interest becomes a critical factor in all long-term investments. And housing becomes one of the important investments that happen. Therefore, in some sense, I think the monetary policy can become more effective than it is now if households become sensitive to interest rate. And much of their actions or behavior is also influenced by interest rate. Monetary policy can have greater effect. Right now, all discussions about interest rate is what corporate behavior will be, what non-corporate business will be. Nobody talks about what household will be. Therefore, in some sense, the phenomenon that may be developing, where the financing route will influence households in terms of investment in houses and homes, may become a factor which is positive in terms of the effectiveness of monetary policy. It is exactly like what we used to say before, that the informal sector is there and the formal sector is small. Now that shift is something reflected in this also. Therefore, to answer your question, if this phenomenon moves up, maybe the monetary policy can become more effective than being less effective.
I think one of the ways in which we have to all this literature, which it's there for everything, whether it's whether money is endogenous or not. There's a range of empirical results from one end of the spectrum to the other. So it becomes an issue of judgment of what matters in a particular context. And there, I think we're already seeing the effectiveness of, we've seen a boom in construction and housing in the last couple of 2 years. As interest rates fell, we saw households moving towards physical assets away from financial assets. So the literature does say that the allocation between a basket, maybe interest sensitivity of savings as a whole is not high, but whether you put it in X, Y, Z. So we've seen, and just the quarterly data shows this issue of household savings falling. We see a rise as interest rates became positive since the end of last year, as RBI was raising rates. And because of the benchmark external lending rate now, the pass-through is much faster in the system. So households do seem to respond. So this issue of being exposed, the interest rate risk, I think households, I don't know, the idea of an independent central bank or inflation targeting MPC, you're immune from political pressures that come when households have to repay. But the issue of financial stability is important. And here I think that when we see the development in India, households have paid huge interest rates in the informal sector, and so on, 20, 21, 22%. We still do some areas. But we are seeing, as credit becomes more widely available, institutional credit, these spreads are going down. Spreads were very high in India. Part of the development is that it's coming down. So then a 0.5% change can also affect, because the quantity is larger of credit, the price change can be smaller, but then the impact on financial instability. So again, that was one of the issues I was flagging, to reduce the volatility, the financial instability. And of course, derivatives and the availability of households, there's a long path before households become comfortable with that. Yeah?
Sir, first the numbers. I mean, housing credit as a percentage of GDP in the US, or credit by household, not housing credit, household credit, is far higher in many countries than India. So India, some way, has a long way to go. It used to be 12, 13%, went to 18%. I think it's in the early 20s at the moment. So from even getting to global peers, getting to that levels, Indian households have a lot more way to go, long way to go. That gives us some amount of room in my understanding. However, the question you have posed is, how do we see the situation a decade down the line, let's say. India's overall debt to GDP ratio, whether it's from corporates, governments, or households, is loaded in favor of the government right now, 87-88%. Corporates are maybe 50-55%, and households make up the tail in that sense. So, over a decade from now, I would expect household credit to have gone up substantially. Definitely, because this is part of the financialization of savings. This is how households are coming into the system. Even if you look at financial inclusion, it's not just opening accounts, but it's also access to credit. And that would show up definitely in terms of household credit numbers going up. Now, how to manage this? Current instruments that we have in the system, where the idea is for monetary policy to become more effective, we need a very quick and accelerated transmission of the process, will also make households more sensitive. That's definitely something that's going to happen. There's no two ways about it. Will they have market-based solutions wherein entry could be looked at? Maybe there will be a move again towards fixed income loans, where households will be shielded from that kind of interest rate vagaries, and which would in turn require the secondary credit market to be developed further. So, not a great example, but Fannie Mae, Freddie Mac of the US. I mean, we might end up needing that kind of a market to develop, or we might have households themselves taking that decision. Looking at flexible credit and having instruments by which they could swap their floating lines to fixed lines. This is something, there is a room for developing that market as well. But I, for one, do not see this, household penchant for credit stopping anytime soon, sir. I don't see that. So one of the behavioral trends that has happened in the last decade or so is that household credit growth has outpaced household income growth. So people are dipping into their savings. We've had data which says that household savings as a proportion of GDP has fallen to 4-decade lows or so. So consumption consumption is rising in India not just by growth but also from behavioral trends. So the question you pose is very material. And the way I see it is either you shield households from the interest rate volatility, or you start providing products for them, and there will be a market to develop that, which will try to solve the problem at a household level. So either you buy credit shields or you buy products which essentially allow you to swap the interest rate risk for a period in time. This has not worked well earlier. We had SBI come up with cases where there were loans which were fixed for a time and then flexible. The market, while they were popular, they were not really frowned upon. They were not very happy. The regulator was not very happy with them. But going forward, we may have to take one of those two ways in which the markets will develop.
Okay. Yes. Okay, we can go to the floor.
Yes, any questions?
Thank you so much for the very insightful discussion, first of all. In the beginning, sir mentioned about the two targets which you have, about output and also about inflation, and it's how it's difficult to handle both with a single instrument. And towards the end, the discussion again came about how households are more exposed to these interest rate shocks over a period of time. One slightly different branch of literature which has kind of emerged over some time is impact of monetary policy on household inequality. So going ahead, do you think the monetary policy should be concerned about that, or is there a way you can bring that into the policy actions which the committees take?
How does monetary policy impact inequality?
Just say whom you would like to answer. Who is your question addressed to?
I didn't have any.
So I will just say while we're discussing that inequality is a hot potato political issue. And a political issue, a question of distribution, should be the government's concern, not a technical MPC or central banker, because that is the way to, bring in political considerations and then you neglect the inflation or whatever growth which is your mandate. Yeah? But overall, part of the reforms as interest rates come down, as credit is more widely available, because RBI in India also does a lot of development in financial and regulatory, which is going to working towards reducing inequality.
You're very
Nothing there. Okay. All right. No, the point really is that you are expecting from monetary policy too many things. I mean, I think monetary policy confined to the issues of, let's say, inflation and growth, aiding growth, and financial stability. But whether impact on inequality and so on and so forth, it goes well beyond the capability of, I should say, of monetary policy. I mean, I think the issue, in fact, is more fundamental. What you are really asking is, does financialization lead to more inequity or inequality in the system? It is not monetary policy per se. Does financialization do this? Now, therefore, it depends upon the nature of financialization. If you really talk about a lot more of financial inclusion, and if you think of the financial system which encompasses even the lower income groups, and is able to provide what the credit that they are requiring, in the final analysis, the financial system has helped rather than increasing the inequality in income. But I think inequality is an issue which is much bigger, much wider, and has to be handled by other instruments.
with the planned opening up of the bond indices, India becoming part of that and global debt money coming in, what do you think will India have to do to be able to control inflation? Because there will be another route through which a lot of liquidity will enter our markets rather than just the local money which is being created over here.
Entry into the emerging market bond index. What do you emerging market bond index?
India will be part of that. I don't know what to talk about it.
Yeah, I don't know, in the morning I had shown these figures, you know how the FDI as a percentage of GDP, although the whole absolute amounts have gone up. I remember Dr. Rangarajan in the early 90s, Kirit Parikar saying, got a call from Dr. Rangarajan saying 3 billion inflows have come in, what do we do with it? and today it is, you know, hundreds of billions that comes in. But our absorptive capacity has improved. So it will not lead to a rise in liquidity or money supply beyond what is required by growth and inflation. Yeah, we have that ability. Authorities have that ability to sterilize inflows if necessary. So so it's a gradual process of liberalization as domestic markets deepen, which is doing.
Because entering into that area essentially means that India is getting more integrated. And as a consequence, what happens in the rest of the world, we will have to reckon with it even more than what we are doing.
We have some ability to smooth shocks, to have counter-cyclical policy.
So volatility will not be a problem.
Probably this is the last question we will take.
So, couple of points and would request your response. That, you know, from our context, do we understand poverty much better, given the policies that we have had, and given the, and also, is it linked to the democratic aspect of things in the recent past? I know the past. The second is, do you think that this is the first time? You know, while helicopter money was always a prescriptive solution given by a lot of people, but this was the first time it was really tested. Can we say that?
Helicopter money was often discussed, but this was the first time it was actually given.
It is about, was this the first time helicopter money was actually tested? And also about your understanding of Indian poverty and democracy.
So my first question was that in the current context, do our policymakers, which is RBI, understand poverty much better, because considering the kind of inflation targeting we have been doing, since it would impact a very large section of the population? That was my first question. The second question was that, you know, helicopter money has been a prescriptive tool by a lot of people earlier, but given that post-COVID, whatever happened, was it the first time it has been very widely tested and then it's sort of failed in terms of the kind of inflation it's resulted?
Actually, that was a check which was given. It was a fiscal handout. And money printed by the central bank, dropped by a slightly different technically. But it's the same thing because the central bank at the same time was expanding its balance sheet and increasing money supply. So, but you know, in the US at least, and this is true, that when you have a liquidity adjustment facility, you were paying banks to deposit excess liquidity in with the reserve, with the central bank, with the Fed. So the reverse repo absorbed excess liquidity created to that extent.
You see, the helicopter money concept is a way of describing the situation. The same thing has been accomplished in India in a slightly different way. We pumped liquidity into the system. We did not actually do as we used to do before of directly supporting the government. But what really happened was the liquidity was increased. The banking system had excess liquidity, and therefore they subscribed to the government paper. So the helicopter money, which I said, is not necessarily go and look at the bed and look at the pillow and see whether money is there. No, that is not the way it happens.
So it's not just a fiscal impulse.
It's not just a fiscal impulse. All this came from the fiscal action. Everybody advised, I suppose including me, that the government should increase expenditure because we are caught in a very difficult situation. Then this was the time at which the government wanted to increase expenditure, and this was the same time at which the revenues were falling because the income was not growing. Therefore, what do? You increase the expenditure, then the net result is borrow more. Borrow more, and the market is not ready to absorb that. Therefore, the central bank comes in through the back door or through the front door. The front door was closed during my time. Therefore, they went through the back door. So the back door for proposition is available elsewhere also. I mean, I think, or Fed did it in a very large way, and therefore it happened. Therefore, the point is, how far can you go? I mean, if you have double objectives, that is one, price control, controlling inflation and growth. Sometimes you really have to decide which takes dominance. I mean, this is that is quasi-political decision.
May I ask one question to Professor Varma? After all, he is also a member of the Monetary Policy Committee. Sir, since since September,
It's up to me whether I'll answer.
Yeah.
You can ask.
That's why the mails. So since September 22, the MPC stance has been on a withdrawal of the accommodation stance, and your comments in the minutes are always reservations on that. If you could elaborate a little bit, if you may. It's up to you, of course.
Are we very out of time? You saved my day.
Thank you, Professor Rangarajan, Professor Ashima, Goyal, Dr. Tirthankar, and Professor Jayanth Varma. This was really very interesting panel, and I said that Guru Shishya panel, and we really had a great time watching Guru and Shishya discussing about monetary policy. So in the morning we had a wonderful session by Professor Ashima Goyal, and yesterday we had a very good session by Dr. C Rangarajan on Indian economy, today on monetary policy. Now I would like to invite Abhinandan Sinha to felicitate our guest Professor Jayanth Varma with a token of appreciation. Professor Jayanth to felicitate Professor Tirthankar Patnaik with a token of appreciation. Thank you. So we are shrinking your tea break with 10 minutes. So quickly in 5 minutes you can take your tea and then move back to the session. Thank you. Thank you so much.